All right, welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're covering a company that went from being General Electric's problem child to one of the hottest stocks on Wall Street. We're talking about GE Vernova, ticker GEV, and Lana. This one has been an absolute rocket ship.
Rocket ship is right. This stock has gone from under 280 to nearly 980 in the past year. That's a 247% move. And the story behind it is just as dramatic as the price action.
So today we're going to break down how GE Vernova went from the division nobody wanted to a $260 billion company sitting at the intersection of literally every major energy megatrend. Let's get into it. So GE Vernova, this is the energy business that General Electric spun off in April of 2024. And if you remember GE's history, the power division was the one that nearly sank the whole ship back in 2018 and 2019. Massive write-downs, billions in losses. Fast forward to today, and this thing is printing money.
The company operates across three segments. Power is the big one. That's gas turbines, nuclear, hydro, and steam. Then you've got wind, which handles onshore and offshore turbines. And finally, electrification, which covers grid solutions, power conversion, solar, and storage.
And here's what makes GE Vernova special. They've got over 100,000 gas turbines installed around the world. That installed base generates these incredibly sticky long-term service contracts. You don't just rip out a gas turbine and switch to a competitor.
Right, and the timing of this spin-off couldn't have been better. We're in the middle of what I'd call a once-in-a-generation energy supercycle. AI data centers are demanding insane amounts of power, the grid needs a massive upgrade, natural gas is having a renaissance, and everybody suddenly wants to talk about nuclear again.
The company's headquartered in Cambridge, Massachusetts. They've got about 77,000 employees, and they pulled in $38 billion in revenue over the trailing 12 months. But the really jaw-dropping number is the backlog, $59 billion in orders. That's like having a year and a half of revenue already locked in.
And that backlog keeps growing. In 2025 alone, they booked $59 billion in new orders, which tells you demand is not slowing down. The energy transition is real, and GE Vernova is right in the middle of it.
The CEO is Scott Strozek, and his story is actually a big part of why investors are so bullish here. He joined GE way back in 2000, so he's a lifer. He worked his way up through the power operations side of the business, served as CFO of GE Aviation's commercial engine operations, and then took over the gas power turnaround.
And that turnaround is the key to his credibility. The gas power division was hemorrhaging money, and Strozek turned it into a profit engine. He oversaw the HA gas turbine platform, which GE has called one of their most commercially successful product introductions ever. When the spin-off happened, he was the obvious choice to lead.
His reputation on the street is basically the operational execution guy. Not flashy, not a visionary speaker like some tech CEOs, just someone who knows how to run a massive industrial business profitably. Kenneth Parks serves as CFO alongside him, bringing 38 years of financial leadership from Owens Corning and Wesco International.
All right, let's get into the financials. And Hudson, these numbers tell a pretty compelling transformation story. Starting with the top line, trailing 12-month revenue came in at $38.1 billion. That's up about 12% year over year.
And the quarterly trend is beautiful, right? You can see this steady climb from $7.3 billion in Q1 of 2024 all the way up to nearly $11 billion in Q4 of 2025.
Exactly. Now, valuation, this is where it gets interesting. The stock trades at a PE of 54 times trailing earnings and about 43 times forward earnings based on 2027 estimates. Price to sales is 6.85. Those are not cheap multiples by any stretch.
Yeah, this is definitely priced as a growth story, not a value play.
It is. But let's look at why the market is willing to pay that premium. The balance sheet is pristine. $8.8 billion in cash, zero long-term debt, negative net debt of nearly $9 billion. For an industrial company of this size, that's remarkable.
Wait, zero long-term debt on a $63 billion asset base?
Zero. And they generated nearly $5 billion in operating cash flow over the trailing 12 months. Free cash flow was $3.7 billion, after about 1.3 billion in capital expenditures.
So they're throwing off serious cash while investing heavily in growth.
They are. Now, margins are the area to watch. Gross margin is about 20%, which is solid for this type of industrial business, but operating margin is only 3.7%, and that's because the wind segment has been dragging.
Right? The offshore wind losses.
Exactly. If you strip out wind, the power and electrification segments are significantly more profitable. Operating margin improvement is the big unlock here. Return on equity is an impressive 44%, though that's partly driven by the relatively thin equity base. Enterprise value to EBITDA is about 46 times. Overall, GE Vernova's financial health is strong. Massive cash position, zero debt, growing revenue, and a $59 billion backlog providing years of visibility. The risk is all in the valuation.
So what are the analysts saying? And Lana, this is a name that gets a lot of coverage.
It does. We've got about 28 analysts covering GE Vernova. The consensus is buy, with 20 buy ratings, 7 holds, and just 1 sell. The average price target is around $842, which actually implies about 13% downside from where we are today at $968.
That's kind of unusual, right? A buy consensus, but the target is below the current price.
It is, and it tells you the stock has run ahead of where most analysts expected it to be. The price target range is wide too, low of 380 from the bears, all the way up to 1100 from the most bullish. Some notable recent calls. Rothschild actually flipped from a sell to a buy in March of 2026, which was a big signal. Jefferies upgraded from hold to buy in December. Goldman Sachs has maintained their buy rating.
And on the other side,
Baird downgraded from outperform to neutral in January, specifically citing valuation concerns. And Seaport Global also downgraded from buy to neutral in December. So you're seeing some pushback on the price, but the fundamental thesis remains intact for most of the street.
now the last earnings report was an absolute monster. Q4 of 2025, reported on January 28th.
Monster is the right word. Revenue came in at $11 billion against estimates of $10.2 billion, beat by 7%. But the EPS number is where jaws dropped. They reported $13.39 against estimates of $2.93. Now, a big chunk of that was a tax benefit, so the headline number overstates the underlying profitability. But even adjusting for that, it was a dominant quarter. They raised the multi-year financial outlook, doubled the dividend, and increased the share buyback authorization. Revenue guidance for 2026 is $44 to $45 billion. The market loved it.
All right, let's do the bull and bear. I'll take the bull case. Number 1, and this is the biggest one, AI data center power demand. These data centers are absolute electricity hogs, and GE Vernova booked over $2 billion in electrification orders linked to data centers in 2025 alone. We're talking 7 to 10 gigawatts of projects. And this is just the beginning.
I'll take the bear side. The valuation is the elephant in the room. At 54 times earnings and nearly 7 times sales, this stock price is in perfection. If you look at the utility sector average PE, it's closer to 18 to 20. GE Vernova trades at almost 3 times the sector multiple. One bad quarter and this stock could fall 30 to 40%.
Fair, but bull point number 2, the nuclear renaissance. The BWRX 300 small modular reactor is a potential game changer. 60% lower capital cost per megawatt compared to competing designs, a 24 to 36 month build cycle, and it's already under construction at Ontario Power's Darlington site. Samsung C&T signed on as a strategic partner to scale this thing globally.
Counter. Offshore wind is a disaster. They've lost over $300 million on Vineyard Wind and Dogger Bank alone due to blade failures. They haven't booked a new offshore order in roughly 3 years, and competitors like Siemens Energy and Vestas are gaining ground. The wind segment is an active drag on the whole company.
Third bull point, the gas turbine backlog. 80 gigawatts of orders stretching to 2029, with a target of 20 gigawatts in annualized production by mid-2026. These are high-margin, long-cycle contracts, and natural gas is increasingly seen as the bridge fuel for the energy transition.
And the bear counter to that is execution risk. Scaling from current production levels to 20 gigawatts is a massive operational challenge. Supply chain constraints, labor availability, quality control at that volume, all real concerns. And if interest rates stay elevated, the financing cost on these massive infrastructure projects goes up, potentially slowing order flow.
Let's compare GE Vernova to a few peers. Lana, who are we looking at?
3 names: Constellation Energy, NextEra Energy, and Duke Energy. And the comparison tells you a lot about how the market is pricing the energy transition. Constellation Energy, ticker CEG, trades at 35 times earnings and 3.5 times sales, with an $88 billion market cap. They're the pure-play nuclear fleet operator benefiting from similar data center demand, but through existing capacity rather than new builds.
So cheaper than on both PE and PS.
Significantly. NextEra, ticker NEE, is the largest renewable producer in North America at $197 billion market cap. They trade at about 23 times earnings and 7 times sales, more diversified but a lower growth trajectory. And Duke Energy, ticker DUKE, trades at about 20 times earnings and 3.5 times sales. It's the traditional regulated utility with steady dividends, the kind of business that GE Vernova is essentially disrupting. GE Vernova commands the highest PE of this group by a wide margin, which tells you the market sees it as a growth company wearing a utility company's clothes.
Let's talk options. What's the options market telling us about GEV?
The put-call ratio sits at 1.29, which leans slightly bearish. Implied volatility percentile is around 55, moderate but elevated. On the call side, you see heavy open interest clustered at the 1,000 and 1,100 strikes, which represents upside speculation. On the put side, the clusters are at 900 and 800, suggesting protective positioning.
So basically, people who own the stock are buying puts to protect their gains, while speculators are betting on even more upside.
That's a fair read. After a 247% run from the 52-week low, it's completely rational to see hedging activity pick up. The options market is essentially saying big move has happened, uncertainty is elevated about what comes next.
Insider activity, what are the executives doing?
It's a mixed picture. In February 2026, there were RSU and option grants to several executives, including CEO Strazik, CFO Parks, and division leaders. On the selling side, the chief people officer sold 5,300 shares at around $8.50 per share in March. That's about $4.5 million. For context, executive selling after a big run-up isn't unusual, especially when it's tied to vesting schedules. The overall insider sentiment doesn't flash any red flags.
Let's hit the key risks and what investors should be watching going forward.
5 things to monitor. First, the wind segment turnaround. This is the single biggest operational risk. Offshore wind losses need to stabilize and eventually reverse. Second, execution on the gas turbine production ramp to 20 gigawatts. That's a massive scaling challenge. Third, BWRX 300 milestones at Darlington. Any delays or cost overruns in the SMR program would hit sentiment hard.
What about the macro stuff?
Fourth, interest rate trajectory. Higher rates for longer means more expensive project financing, which could slow order flow. And fifth, the next earnings report. Q1 2026 results are expected on April 22nd, with estimates at $1.78 in EPS. After that massive Q4 beat, expectations are elevated. The metric I'd watch most closely is the order backlog number. If that stays above $50 billion, the growth story remains intact.
All right, Lana, bring it home for us. What's the bottom line on GE Vernova?
GE Vernova is a genuinely transformed company. The balance sheet is a fortress, $8.8 billion in cash, 0 debt. The order backlog of $59 billion provides visibility that most companies can only dream of. They're positioned at the intersection of 3 secular tailwinds: data center power demand, grid modernization, and the nuclear renaissance.
And the risks?
The risks are real. The valuation demands flawless execution. Offshore wind is still bleeding money, and at 54 times earnings, any stumble gets punished severely. But the underlying business transformation from GE's problem division to this, it's one of the best turnaround stories in industrial history.
The metric to watch is that order backlog number. If it stays above $50 billion in the next report, the growth thesis holds. If it starts shrinking, that's your early warning signal. I love this quote from CEO Scott Strazik. He said, "The work to both electrify and decarbonize the world is complex, dynamic, and constantly changing."
That really captures it perfectly. This isn't a simple story. It's a company navigating one of the most complex transitions in industrial history. The fact that they're doing it with a clean balance sheet and a massive backlog is what gives investors confidence.
And I think that quote applies to investing too, right? The energy landscape is changing fast, and GE Vernova is one of those companies where you either believe they can execute on this massive opportunity or you think the valuation has gotten ahead of the fundamentals. That's the debate. That's going to do it for episode 97 of Charged Alpha. Today we covered GE Vernova, ticker GEV, the energy transition's Swiss Army knife. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, no sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.